Hello and welcome back to the Finspire Focus on the Markets third quarter 2020 edition. We are doing a mid-quarter update today to give you a sense of what occurred, not just during this first 50 or so days of the third quarter, but to see how much progress we've made since the end of the second quarter on June 30th. It's good to be with everybody again. I'm Karam, Chief Investment Officer with Finspire, and today we're going to share with you some areas of economic progress. We're going to look at the labor market. We're going to look at how those have impacted the equity markets and get into ultimately our keys and the progression of our keys to a sustained economic and market recovery. As always, we're sharing our opinions mixed with the facts that are presented here today. These opinions are our own, and it's key to know that past performance is no guarantee for future results. The big story of the week of the quarter so far has been the release of the second quarter GDP growth figure. It was a dismal 32.9% contraction after a first quarter report of a 5% contraction. This continues to be one of the more unusual economic cycles we've seen, both on the downturn and now currently we may already be out of a recession and well on our way in an economic upswing. As a matter of fact, the Atlanta Federal Reserve has a forecast on their website, and today it says that third quarter GDP is estimated to be at positive 26%. So we saw a big economic downturn followed by what appears to be a very strong third quarter of economic performance. So where is that coming from? We have seen both domestically here in the US and in China, the world's second largest economy, both moved into expansionary territory when it comes to key global economic activity indices. In this case, we're looking at manufacturing. Anything above the dotted line over 50 indicates expansion. Anything below 50 indicates contraction. And you can see both the US and China have recovered into expansionary territory from a manufacturing perspective. Where are we seeing those pockets of performance, of positive economic performance? It was in both building permits. Housing permits are bounced off the mat to get closer to their pre-COVID levels, along with housing starts and also single and multi-use units in that sector of the economy. It's a key driver of economic activity to see the housing and building permits bounce off the mat. When we transition to the labor market, we have seen a restoration of many jobs. However, we're still well behind where we were pre-COVID. And here, what you see here is just a sharp upswing in initial jobless claims, which spiked well above its normal number where we were pre-COVID, around 250,000 per week. You can see they spiked well over 6 million, and the latest report was at 963,000 of initial jobless claims. So still on the right track, but as people get back to work during this post-COVID period of time, we want to see this continue to go lower. That means fewer people are claiming unemployment benefits. Alongside of that, the labor force participation rate, again, bounced off of its low, although we're not really anywhere close to where we were pre-COVID levels. We are back on the right track, but we'd love to see the labor force participation rate continue to grow, which will only fuel more positive economic results. From an S&P 500 index total return perspective, it's been just a remarkable rebound after experiencing a drawdown of 34% from February 19th to March 23rd. We are now at plus 6% year to date after dividends as of August 19th, 2020. So this has just been a remarkable comeback, and perhaps what's even more remarkable is the speed at which the S&P 500 itself has rebounded into positive territory. But more on this, let's look into what's driving this result. And key contributors to the S&P 500 index, especially in terms of size, are these Fang stocks. Fang is an acronym for Facebook, Amazon, Apple, Netflix, and Google. And as you can see here, the performance of these Fang stocks has been extraordinary. And moreover, it's been extraordinary not just over the last 5 years, but you can see the concerted spike that we've seen just in the last, just year to date. And relative to the rest of the S&P 500, meaning the other 495 stocks in the S&P 500 index, you can see the huge disparity in returns of those Fang stocks and in the S&P. Those Fang stocks are all in the tech sector. And so managers with such as growth equity strategies with a bigger concentration towards technology naturally are going to have much better returns than, say, value sectors focused in, say, financials or utilities or consumer defensive type stocks. And that's one of the reasons where we also have had reduced interest rates. With those lower rates came positive returns in fixed income. So what you'll see here is you can see fixed income returns measured by the Barclays Aggregate Bond Index at 6.8% positive, followed by the S&P 500 at 5.8% positive. But you can see other asset classes haven't shared in those same types of results, largely due to those Fang stocks. And when you look outside of the US, for example, emerging markets are right around zero so far year to date. International developed equities are down about 4%, small cap equities down about 10%, commodities down about 10% year to date. So when you look beneath the surface, beyond those big company technology stock names, you don't see the same results spread out around other asset classes. And that's why you see the balanced portfolios now venturing positive for the year to date, but not quite near both the core fixed income and large cap equity boxes that you see here so far in 2020. Because of those Fang stocks, we're seeing a really historic disparity in growth versus value performance. You can see the spread here, which is 387% over the last 20 years of growth versus value. The last time we saw anything close to this was the year 2000, where we were experiencing the tech bubble. And really what happened post-tech bubble in early 2000 wasn't so much that the index did that poorly, but the rotation, there was a rotation of where the sources of returns were concentrated. With the elevated price levels of certain stocks, especially those Fang stocks, we're seeing, and couple that with reduced earnings expectations due to COVID-19, we've seen a big spike upwards in the price to earnings ratio of the overall S&P 500 index. And you can see here the latest report was 22.3 times forward 12-month looking earnings reports as a multiple. Compared that to the tech bubble that I just mentioned at 24.5 times, it does look a little bit similar to that period of time. But like I said, it's not as if the entire index tumbled significantly post the tech bubble peak. Instead, there was a bit of a rotation. So could we see a rotation here from growth equity eventually to value? That's very possible as we look forward 3 years from now. And you can see valuations not just were high, the highest they've been on the S&P 500 since that tech bubble peak, but they are high on a historic basis, whether you're looking at price to earnings ratios, price to book, price to sales, and price to cash flow. All those metrics, it appears the S&P 500 index as a whole is valued, valuations are stretched. However, one key metric that is allowing additional cash flow to flow into equities and into the index strategies is dividend yield. So dividend yield, however, is higher, is at its higher point relative to historical averages, and certainly higher than it was a year ago at this time. So at 1.6%, the dividend yield in the S&P exceeds that of the 10-year Treasury. And so long as that disparity is there, it can be a favorable environment for equities, even despite valuations being potentially stretched. When you look globally, valuations are not as high as they are here in the United States, primarily because technology is usually comprised as a lesser composition in foreign or non-US indices compared to the S&P 500. So opportunities do remain abroad from a valuation standpoint. And so I wanted to revisit a slide that we've assembled in previous market updates. It's our keys to a sustained recovery. And this has been post-COVID outbreak. We wanted to make sure that there was a progress report that we could circle back with you on and say, where have we been? Where are we progressing? And we really looked at concentrating in 5 different areas and 5 different keys to a sustained recovery. And we put here a thumbs up, thumbs down chart from May 15th, June 30th, and August 15th. We'll have another one as of the quarter end, September 30th, that we'll post for future consumption in October. But we really looked at the 5 keys to the sustained recovery. The outbreak mitigation. So most recently, we've been stymied by this COVID conundrum where the number of cases has been rising, but the death rate has been falling related to COVID-19. And so what was a thumbs up before we got the second wave of increased cases turned into a thumbs up and a thumbs down. If we see we have seen some recent progress with both cases and the death rate continuing to come down, then we could be poised for a thumbs up as of September 30th. But right now it's a little bit of a mixed and what I call the COVID conundrum. Oil price stability. That was a big deal earlier this year where oil actually sold for negative $37 a barrel at one point due to a lack of global economic demand. That since has stabilized. So in order to have a sustained recovery, you cannot have oil prices tanking or commodity prices tanking. You want to see some stability there. And so it's a thumbs up, remains a thumbs up. Fiscal and monetary support continues to be there. And I would indicate that even though there's a debate in Congress today about whether that 4th COVID-19 relief and stimulus package could pass Congress, I would argue that despite that, both on a fiscal basis from what Congress has injected into the economy, plus the liquidity measures that the Federal Reserve has continued to support the capital markets. If I could give this another couple thumbs up, I would. This has been steady and strong from the very early reaction to COVID-19. Credit market stability continues to improve. So we had some negatives early on back in March and April, where credit spreads really began to widen substantially to levels we hadn't seen since 2016, but they have since come down in a very healthy way. So credit spreads are tightening. They've got a long way to go, and so we still give that a mixed thumbs up and thumbs down, but certainly moving in the right direction. Then the fundamentals. The fundamentals back in May were poor. We knew we were in the depths of the recession at that point. We knew we were in for a largely negative second quarter GDP figure, but markets rallied. And that's what markets do. Equity markets rally usually in advance of the fundamentals improving. And so the fundamentals have improved. Earnings have improved over expectations. We've also seen these other data points of the economy, such as housing starts and the labor force improving, which are also ultimately good for earnings reports in the future. So earnings and fundamentals, overall still a thumbs up and a thumbs down report, but certainly showing progress, which will be critical to maintaining this and sustaining this economic recovery. The equity market by the S&P 500 is up about 10%, approximately 10% from the quarter end, June 30th. So we're looking forward to hopefully another quarter of sustained both economic and market growth. So with that, we thank you for joining us today for this quick mid-quarter economic and market update. We'll see you next time.